Good morning. Thank you very much for joining us for this webinar on charitable giving and for taking the time to connect with us in this strange new world of remote working from home, which is actually beginning to feel quite normal. These webinars are a way of bringing our clients, our communities and our colleagues together. I hope you can hear me. They've decided to cut down a large tree just down the road from me. So you may hear chainsaws and tree chippers from time to time, but I hope it won't disturb us too much. So I'm going to be speaking for just under 30 minutes. If you've got any questions, can you please submit them on the question and answer function on your screen? I'll answer questions at the end, but I'll try and pick up questions that you submit as we go through if I manage to catch them in time. But I'll definitely come back to them at the end and answer as many as I can. We'll also be recording this webinar and we will be sending the recording out afterwards. Okay. So who am I? So my name is Vicky Day and I'm a trust and estate planning lawyer with Owen Mitchell. A very brief outline of what I'm going to be talking about today. I'm going to speak a little bit about our victory in the Supreme Court last year. This was the Routier case, which involved a gift and a will for charitable purposes. We were very proud of our success in that case, actually, as on the day that the judgment was handed down, there were 3 judgments handed down by the Supreme Court, 2 of which were matters that this firm had handled and both of which we were successful. And then after talking about that case, I'll talk a bit about effective charitable giving through a will, and then the various things to consider to minimise inheritance tax, and then I'll consider briefly income tax and capital gains tax, after which I will answer questions. So the first thing I think is to actually talk a bit about what actually a charity is. Let's remind ourselves, the principles of charity actually go back to the Statute of Charitable Uses, commonly known as the Statute of Elizabeth, and this does mean Elizabeth I back in 1601. And it was actually the preamble to that statute which set out the list of activities or purposes that the state then believed were beneficial to the common good and to which the state wanted to encourage private contributions. And there were originally 3 purposes, which were the relief of poverty, the advancement of education, and the advancement of religion, which were de facto considered to be for the common good or public benefit. Since that time, the law on charity has been refined a lot. There have been other charity acts, more meanings of charity given, so that the net is much wider to capture things like community sports clubs, those sorts of things, and much more for the public benefit. The present position for tax relief for gifts to charities is actually set out in the Finance Act 2010. So in order to qualify now, a charity must be subject to the court jurisdiction in a EU country or in one of the countries which are mostly closely aligned. The charity must be registered in that jurisdiction, and the administration of the charity must be carried out by people who are fit and proper managers. So the Routier case. So Mrs. Beryl Coulter, she died in 2007. She'd lived all her life in Jersey and therefore she was domiciled in Jersey. She left a large estate, which of course, as she was not UK domiciled, was not subject to inheritance tax, apart from the £2 million of investments that she had in the UK. Now, in her will, she left her residue of her will on a trust for the provisions of homes for the elderly in a specific parish in Jersey. And she also left instructions that a suitable plaque was to be erected in memory of her late husband. And she also wanted various buildings, etc., to be named after him. So it was clearly a very happy marriage. Now, if the gift was charitable, then it would be free of inheritance tax. If it was not, then there was potentially £600,000 of tax payable, which was a considerable sum and worth fighting over. So HMRC decided that the estate was taxable, and so we appealed that decision, and we argued two lines. The first was that it was trust for charitable purposes, so it didn't matter if it was for recipients in Jersey. And the second was that even if it was, EU law prevents the restriction of the restriction on the freedom of movement of capital. This is set out in the Maastricht Treaty, and you'll recall it's not only between member states, but also between member states and third countries, which is basically any other country outside of the EU. Sorry, there's a slight delay in clicking the slides. There we go. So the exemption for charity is actually set out in the Inheritance Tax Act 1984 under section 23, which sets out that if property is given to charities if it becomes the property of charities or it's held on a trust for charitable purposes only. And section 272, which is the definitions section of the Inheritance Tax Act, sets out that charity and charitable have the same meanings as in the Income Tax Acts. The difficulty was that charity is defined in those acts, but charitable wasn't. So there are two ways of making a charitable gift. It can either be to an existing charitable institution, or it can be to a trust held for particular charitable purposes. And Mrs. Coulter's gift, as you will recall, was the second kind, because it was a trust set up to create properties for housing these elderly residents of this parish in Jersey. Now, gifts to charity, this is the first option on the slide, are actually constrained by a case from the 1950s that said a charity had to be established in the UK. But our argument was, as we were arguing the second way of making a gift, i.e. to a trust for charitable purposes, that all we had to show was that the trust was for charitable purposes, not who the recipients were. We've actually subsequently registered this trust with the UK Charity Commission, so we know that the charitable purposes point has been established. Okay, in the end, the Supreme Court didn't actually decide the charitable purposes point, and we won the appeal on the EU law point. And that was that the free movement of capital, as I said before, is not only between member states, between themselves, but it's also between member states and third countries. And ironically, HMRC, having argued that the release didn't apply because it wasn't for a UK charity, then tried to argue that Jersey was part of the UK for these purposes, so that the free movement of capital principle didn't apply. The point of law that was actually established in the Supreme Court was that Jersey was a third country for these purposes. Now, it followed a line of cases in the European Court of Justice where they've ruled denying a tax benefit in a member state to those where they've ruled that denying a tax benefit to those in a member state to those outside breaches the principle of free movement unless the breach is justified. So it all turned on whether or not the breach was justified. If you're looking at point 2 here, the Court of Appeal ruled that restriction to the UK was justified by the absence of a mutual assistance agreement between the two jurisdictions. And it is this that the Supreme Court overruled, that there was no restriction on the face of legislation and the UK courts couldn't insert it, which gave us that victory. Now, if like me, your head is spinning a little bit, because as I said, I'm a trust and tax lawyer and not an EU law expert, here's a little bit of light relief. What's the connection between these four? I'll just set out in case it's not clear. They are a bison, a hand grenade, a photo booth, and a Christmas dinner. If you make a guess, you can submit your answers on the Q&A panel, and we'll see at the end if anybody guesses correctly. There are no prizes for guessing correctly other than the kudos of getting it right. So let's move on to giving to charity in your will and how the tax relief works. So I'm going to explain very briefly how inheritance tax works. We've got quite a mixture of people who have logged in to speak to us today. Some of you, I suspect, have little knowledge of inheritance tax, and some of you will have quite a lot. So forgive me if I just set out very briefly how it works, because I think that will help people to understand the following slides where they don't have that knowledge. So inheritance tax is a tax on death. It's also a tax on life, but I'm focusing on death here. When somebody dies, their whole estate is taxed. The first part, the nil rate band, is taxed at 0% or 0%, which is why it's called the nil rate band. Anything over that is taxed at 40%. Now, the nil rate band is currently £325,000 per person. This amount may be restricted by lifetime gifts, etc., or it may be increased by the residence nil rate band or transferable residence nil rate band. Those details will be on the scope of this seminar. So for the purposes of this webinar, let's just think about the 325,000. There are some gifts to specific people or organisations that are exempt from inheritance tax, and you probably know these. They are any gifts to a spouse, to a civil partner, to a charity, and even to political parties. So there's 100% relief on gifts in wills to these. But the main thing to keep in your head for the next few slides is any gift to charity is 100% exempt, and any gift in excess of the 325,000, this is what I'm using for my example, is taxed to inheritance tax at 40%. So the difficulties arise when an estate is taxable and the residue is left to both exempt and non-exempt beneficiaries. So exempt charities, non-exempt usually other family members. So let's look at this example. Florence has a will, and in her will she leaves her estate sorry, my slides have got a little bit confused. There we go, that's better. Florence has got an estate of 2.4 million. She wants to leave 1/4 to her nephew Jim and 3/4 between 3 charities. So if we do the maths, 1/4 of 2.4 million is £600,000, and the tax, the inheritance tax on that £600,000 is 99%. I know it says 36%, and I've talked about 40%, but ignore that for the moment. Now, without a special provision, Jim will only get 501,000 of his 600,000 because his share will bear all of the tax. Do you remember the charities are exempt, so they can't receive anything? Okay. Now, if Florence doesn't want that inequality, she could do it a different way. She could give Jim a gift of 600,000, like a pecuniary legacy, and then the residue of her estate to the 3 charities. Now, if she did that, because the charities can't pay tax, we can't pay tax on their shares, Jim's gift will be grossed up, so that in fact he receives a lot more than the 600,000, actually 754,000, on which the tax would be 154,687, in order that the gift that he actually receives, the net payment that he receives, is 600,000. So there the charities don't actually pay the tax, but because Jim's gift is grossed up to 754,000, their gifts are reduced, and therefore they end up losing about £50,000 from their £600,000 inheritance. And of course, £154,000 of tax is much more than the £99,000 that Jim would pay on a gift subject to tax. So a much better way of doing this, but the math is quite complicated, would be if Florence gave £701,000 to Jim, subject to its own inheritance tax. And if you do the maths, he then has to pay £135,000 of tax on his gift, which means he gets £566,000, and then the charities each also get £566,000. HMRC still get £36,000 more tax than the first alternative, which was £99,000 payable on Jim's gift of £600,000. So this is horrendously complicated, but as we set out here, tax is not fair, and the rules are actually fiendishly complicated. So how can we minimise the tax? So a rule was introduced a few years ago to encourage more charitable giving on death, and this is the 10% rule, which is basically that if you give 10% of your taxable estate on death to charity, not only is the gift itself free of tax, but the rate of tax on the remainder of your estate reduces from 40% down to 36%. That's why you saw the 36% in the previous examples. Okay, and this really applies only on death, and it's the taxable estate that you have to have 10% of, not 10% of the whole estate. And taxable estate will actually include gifts passing by survivorship, gifts in qualifying interest in possession, and gifts of reservation of benefit, or can do. And if you can make a gift of 10% of your taxable estate to charity, then it reduces the tax on the remainder of the estate. Now, if your will gives 4% to charity, it is actually worth upping that to 10%, and we'll show you how the maths works on that. So this is an example of Phyllis, who dies with an estate of £625,000. You can see we've chosen these examples because they fit very neatly into the tax allowances. So her nil rate band or tax-free allowance is £325,000, which leaves a taxable estate of £300,000. Now she gives £30,000 to Chichester Festival Theatre, which is a very good theatre, and obviously a charity, and the rest to her nephews. Then, because she's given 10% of the taxable amount, the inheritance tax on the remaining £270,000 is only 36%. So you see in this example, her nephews would end up with £497,800 after the payment of tax and the charitable legacy. Let's compare that with Ronald, who coincidentally has exactly the same size estate. Now, Ronald also has a £325,000 nil rate band, but he's only giving £12,000 to Pallant House Gallery, very good art gallery, again for charitable purposes, and the rest of his estate is going to his nieces. So £12,000 is only 4% of the taxable estate, 300,000, and therefore, although the £12,000 goes free of tax, the inheritance tax on the remaining £288,000 is 40%, which leaves his nieces with exactly the same amount as Phyllis's nephews received. So let me show you how this works in a table. So you'll see that if you actually give £12,000, which is 4% of the taxable estate, then the rate is at 40%, and the family get £497,800. You'll see as we go up through the percentages, 5%, 6%, 7%. Let's look at 7%. So now the charity is getting £21,000. So obviously that reduces the taxable estate, but it does mean that the family get less because more is going to charity. And then if you continue up to 10%, you'll see that we've there hit the magic number of 10%. And at that point, the rate of tax on the rest of the estate drops to 36%. So it is actually HMRC that are the loser here, not the charity, not the family, who get exactly the same amount as they would have if the charitable gift had been only 4%. Right. So if there was no charitable gift under the will, or there was only the 4%, and you wanted to increase it, you're a beneficiary of a will and you want to increase the gift to charity to 10% in order to take advantage of this 36% rate, how can you do it? Well, you can still do it by deed of variation. And the rules around deeds of variation are that they have to be done within 2 years of the date of death of the deceased. You can actually do it on the 2nd anniversary of the death, but that's the last date that you can actually sign a deed of variation. It has to be in a prescribed form. There's specific reference to the format in the Inheritance Tax Act 1984 under section 42. And obviously, if you increase the gift from 4% to 10%, or from anything between 4 and 10% to 10%, then that will increase both the gift to the charity and the ultimate amount that the family inherits. It is just the tax that reduces. For this to be effective, notice of the variation must be given to the charity that benefits. This is a requirement in the law to stop people being a bit devious and actually doing deeds of variation to increase the gift to charity, not actually telling the charity that. So the charity thinks that they're due 4%, they can see that on the face of the will, but in actual fact the gift has been increased by a deed of variation. If there was no previous gift at all in the will to charity and a deed of variation is done to give 10%, it actually only costs the non-exempt beneficiaries, the beneficiaries paying tax, £240 to give £1,000 to charity. So it's actually a pretty effective way of giving to charity. I had a case recently where, on the maths, by making a gift of £46,000, it cost the beneficiary £11,000 on those particular figures. So it was well worth her doing it. Okay, let's speak a little bit about capital gains tax and income tax now, and this is under gift aid. So principles of gift aid, well, they apply to cash gifts only. So when you make a gift to a charity, the charity can claim back the basic rate tax that was paid on the income from which the gift was made. So this is just really claiming back tax. So if you, for instance, give, say, £80 to a charity, in theory, you would have earned 100, or a basic rate taxpayer would have earned £100 of income. That £100 of income would have had income tax deducted at 20%. So in our example, that would be £20. And it is that £20 that the charity can claim from HMRC. And obviously the £20 is 20% of £100 of earned income, but is 25% of the £80 given to charity. And that tax, the £20 tax, must have been paid in the tax year of the claim. So the donor must have paid enough tax, whether that's income tax or capital gains tax, to cover the amount reclaimed by the charity. A little bonus for high rate taxpayers who pay 40 or 45% tax is because the charity can only claim 20%, the basic rate tax back, the higher rate taxpayer can also claim themselves the additional rate that they've paid. And you see, sometimes that can be even more if the dividend income is at the higher rate taxpayer's rate of 31.1%. Now, there is another relief which is much less known. It really only applies to seriously high income earners, and that's a tax relief on outright gifts. So potentially you can make a very, very big tax saving as you get relief from your income tax of the value of the property that was gifted to the charity. There are quite a lot of limitations on what can be given. So a gift, capital gift, has to be of quoted investments or land or buildings, and that usually means freehold. Both investments and buildings and land have to be in the UK. And it is the entirety of the land or buildings that must be given. You can't give part and keep part. And the whole value of the gift is deducted from your income. So you'll see in this example, if Stephen has taxable income of £400,000, that would be nice, and he makes a qualifying gift, say of investments worth £100,000, then he will get £45,000 income tax back, because obviously he's a higher rate taxpayer and pays a marginal rate of £45,000. No tax cost to the charity. There are quite stringent anti-avoidance rules, so the taxpayer must have owned the asset or the buildings for at least 4 years. And in the case of land, the relief is actually cancelled if you reacquire it in the 5 years following the gift. So it must be a clean gift of the freehold to the charity with no further interest in the land for at least 5 years. This is to stop people trying to play the system when they've got land there for development, etc. People who are selling land for development do ask if they can use this relief, but as set out above, the entirety of the land and buildings must be given. Although I suppose they could actually carve out a few acres into a separate title and give that to charity before sold for development. That would probably work. So how about sharing your windfall? If you have got development land or just got an asset, say a valuable painting or an artifact that you've held for a long time, which has actually increased in value. Although you won't be able to get the income tax benefit described earlier unless you are on something like a valuable painting, you can give it away to charity with no capital gains tax. Now, normally when you give away an asset that's increased in value, then it's a disposal for capital gains tax, and then maybe capital gains tax paid on it. But if you give the asset to charity, then there's no capital gains tax on your gift. There's no gain, no loss. So they acquire it at your acquisition value. However, because it's a charity, they then go on and sell it. Charities don't pay capital gains tax, so they won't have any tax liability on that gift or on that sale. If you want a charity to benefit from a windfall, you expect to get on the sale. So the obvious one is development value, land subject to development value, because obviously it will have massively increased in value if it's being sold for development. Then give the asset to the charity before the sale so that they can get the benefit of the increase in value without any capital gains tax. And if you only want to give part of the proceeds, then you need to set this out, unlike with the gift of quoted investments or land, where you have to give the whole amount of the land to get the income tax relief. For capital gains tax, you can actually, say, declare a trust giving part of the land to a charity and retaining part yourself, and the bit to charity will be exempt from the capital gains tax on the increase in value. So that is all I was going to talk to you about today. No. Let me just go back to the pictures then. I had absolutely no guesses at all as to how these are linked, so I suppose I'm going to have to tell you. The Charities Aid Foundation carried out a survey of gifted charity shops a few years ago, and they found that these were their findings. So there was a stuffed bison which was donated to Barnardo's. There was a full-sized photo booth which was donated to Sue Ryder. There was a live hand grenade that was donated to a Sense charity shop, and the shop had to be evacuated and they had to get the emergency services in to make everything safe. And I think this is my favourite. A supporter of a sponsored dog at the Dogs Trust didn't want his dog to be missing out at the festive season, and so delivered up a full Christmas dinner in a jiffy bag to the Dogs Trust. You really couldn't make it up. Are there any questions? So obviously this material is for guidance only. It's not a substitute for legal advice. We've just touched on the very generic points here. Still don't see any questions. No. I'm just going to flag up then. I'll give you the address in a minute. If you've got any further questions, you want to send them to us at our email address. But just flagging up here, we do have a webpage with coronavirus updates, which we update every day. Please do take a look at it. It's got a lot of useful information on it. And here's our email address. If you have got any further questions, please do send them to this address. If you've got any ideas for webinars for our weekly events, we'd love to hear what you want covered. I'm just waiting a couple more minutes for questions, but there don't seem to be any.